It is August 2026 in Ankara, Turkey. The tarmac at the capital's airport is locked down for an unannounced, highly irregular security maneuver. U.S. President Donald Trump is not boarding Air Force One. Instead, under the cover of the airport's standard operations, he is being secretly shuttled via a catering truck to a smaller, less conspicuous aircraft. The extraction was triggered by immediate intelligence regarding Iran. Tehran had just elevated a new slate of wartime commanders across its security and military establishment, signaling a high-alert posture. This military shift was already bleeding into the surrounding waters. A Houthi raid on a commercial vessel had just resulted in the deaths of 6 people. When a localized naval skirmish forces a sitting U.S. president to abandon his primary aircraft, it proves that regional escalations now pose a direct physical risk to Western heads of state. This map shows the exact geography driving the conflict, the Strait of Hormuz. Look closely at the narrow gap connecting the Persian Gulf and the Gulf of Oman. Most global maritime trade and oil must pass through this bottleneck. In the days following the Ankara extraction, Washington and Tehran began publicly trading demands over whether this narrow strip of water would remain open or be forcibly closed off to international shipping. Modern supply chains are built on efficiency, not redundancy. If this specific artery is severed, there is no viable alternative route to move that volume of energy out of the Middle East. The true danger is the reality that a single geographic bottleneck has the physical capacity to bring the entire global economic engine to a halt. The threat alone was enough to trigger an immediate reaction. Global energy markets panicked, pushing Brent crude up to $89 a barrel and sending oil to near one-week highs. As diplomatic channels appeared stalled and hopes of a U.S.-Iran deal began to fade, that panic spilled over from the energy sector into international equities, triggering severe sell-offs. This chart traces the fallout on the Pakistan Stock Exchange. Over a rapid 48-hour window, the KSE 100 index experienced a steep 2-day slide, losing 1,464 points as investor confidence collapsed. With volatile stocks dropping, capital flight took hold. Terrified investors dumped their shares and rushed towards safe haven assets, driving the price of gold up by $24 an ounce. No missiles were fired at a commercial port, and no blockades were officially erected. Yet geopolitical fear alone instantly erased billions of dollars from the global economy. Facing an economic hemorrhage, neighboring nations could not wait for Washington to stabilize the situation. The looming crisis forced an immediate push for back-channel negotiations. Pakistan emerged as a critical mediator. Interior Minister Mohsin Naqvi launched emergency meetings in Tehran, sitting down directly with the Iranian president and top officials to de-escalate the standoff. These efforts produced tangible public signals of relief. Shortly after, Pakistani Defense Minister Khwaja Asif announced that Washington and Tehran were finally moving towards an arrangement regarding Hormuz. This crisis demonstrated a change in the diplomatic hierarchy. To prevent a collapse, regional powers intervened directly, sidestepping the wait for Western mediation. The immediate military threat and the market crash were contained, but the event exposed the fragility of the existing U.S.-led deterrent systems in the Gulf. Recognizing this vulnerability led directly to a formal structural change, the signing of the Makkah Agreement. This long-term defense pact brought together 3 major regional powers: Saudi Arabia, Turkey, and Pakistan. The explicit goal of the pact is to consolidate efforts to address regional challenges and maintain local stability, heavily reducing the reliance on outside forces to keep the peace. By formalizing this alliance, the Middle East is actively constructing its own unified security apparatus, designed specifically to insulate the region from the fallout of future disputes between the U.S. and Iran. In a matter of days, a localized naval threat rippled outward, forcing a U.S. president into hiding, driving oil prices upward, and crashing international stock exchanges. Geographic choke points are no longer localized issues. Vulnerability in a single strait now creates systemic risk for every nation on the map. The period of relying on singular superpowers to guarantee the safety of international trade has passed. The August 2026 crisis rattled the markets, but its lasting impact is the rise of regional alliances as the primary guardians of global trade stability.